How to time the stock market. Timing the stock market is a daunting task that many investors dream of mastering. The allure of buying low and selling high, capturing the market's peaks and troughs, is undeniably attractive. However, the complexity and unpredictability of the stock market often make this goal seem elusive. Investors who lack a strategic approach may find themselves succumbing to emotional decisions, ultimately leading to financial losses. This video aims to demystify the process of timing the stock market by providing a structured approach through recognizing market trends, monitoring economic indicators, and using technical analysis indicators. Point 1. Recognize market trends. Understanding market trends is crucial for timing the stock market effectively. Trends reflect the general direction in which the market is moving, and recognizing these patterns can inform your investment decisions. Example 1. Bull and bear markets. A bull market is characterized by rising stock prices and investor optimism. During a bull market, it's wise to ride the upward trend, but being aware of potential overvaluations is key. Investors should look for signs of over-exuberance, such as excessively high price-to-earnings ratios or widespread speculation. For example, the dot-com bubble of the late 1990s saw many technology stocks trading at unsustainable valuations, leading to a severe market correction in the early 2000s. Conversely, a bear market features declining stock prices and investor pessimism. Recognizing a bear market early can help investors minimize losses by moving assets to safer investments or even short selling to profit from the downturn. The 2008 financial crisis is a classic example where early recognition of the housing bubble and subsequent market downturn allowed some investors to protect their portfolios and even profit from the falling markets. Example 2. Sector rotation. Different sectors perform better at different stages of the economic cycle. For instance, technology stocks often lead during periods of economic expansion, while consumer staples tend to be more resilient during recessions. Understanding these sector trends can help investors adjust their portfolios to align with the prevailing economic conditions. During the economic expansion phase, sectors such as technology, consumer discretionary, and industrials typically perform well as businesses and consumers spend more. For example, the economic boom from 2010 to 2019 saw technology giants like Apple, Amazon, and Google experiencing substantial growth. In contrast, during economic downturns or recessions, sectors like utilities, healthcare, and consumer staples tend to outperform. These sectors provide essential goods and services that people continue to use regardless of economic conditions. For instance, during the COVID-19 pandemic in 2020, consumer staples and healthcare sectors remained relatively stable compared to other sectors that saw significant declines. Point 2. Monitor economic indicators. Economic indicators provide insight into the overall health of the economy, which in turn affects stock market performance. By keeping an eye on these indicators, investors can make more informed decisions about when to enter or exit the market. Example 1. Gross domestic product, GDP. GDP measures the total economic output of a country. A growing GDP indicates a healthy economy, which generally bodes well for the stock market. Investors should pay attention to quarterly GDP reports and revisions to gauge the economic trend. For instance, the rapid GDP growth in the post-World War II era was a sign of economic strength and correlated with a significant bull market in the 1950s and 1960s. Conversely, the negative GDP growth during the Great Recession of 2008-2009 signaled economic distress and coincided with a major bear market. Example 2. Unemployment rate. The unemployment rate is a key indicator of economic health. High unemployment can lead to reduced consumer spending, negatively impacting corporate profits and stock prices. On the other hand, low unemployment suggests a strong economy, likely driving stock prices higher. For example, the historically low unemployment rates in the United States from 2017 to early 2020 supported a strong bull market as consumer confidence and spending remained robust. Conversely, the spike in unemployment during the COVID-19 pandemic in 2020 contributed to market volatility and declines, although unprecedented monetary and fiscal stimulus helped stabilize the markets more quickly than in previous recessions. Point 3. Use technical analysis indicators.
Technical analysis involves using historical price and volume data to forecast future market movements.
By incorporating technical analysis indicators, investors can refine their timing strategies and make more precise market entries and exits.
Example 1. Moving averages. Moving averages smooth out price data to identify trends over specific periods.
The 50-day and 200-day moving averages are particularly popular among investors. When a stock's price crosses above its moving average, it can signal a buying opportunity.
Conversely, crossing below the moving average may indicate it's time to sell.
For example, if a stock has been trading above its 200-day moving average for an extended period but then falls below it, this could be a signal that the stock is entering a downtrend.
Investors who heed this signal may decide to sell their positions or avoid new investments in that stock.
Example 2. Relative Strength Index, RSI.
RSI measures the speed and change of price movements, ranging from 0 to 100.
An RSI above 70 suggests that a stock is overbought and may be due for a price correction, while an RSI below 30 indicates that a stock is oversold and could be primed for a rebound. For instance, during the market sell-off in March 2020, many stocks had RSIs below 30, indicating they were oversold.
Investors who recognized this signal and bought during this period benefited from the subsequent market recovery.
Conversely, during periods of market euphoria, stocks with RSIs above 70 may be at risk of a pullback, suggesting a cautious approach or potential profit taking. Conclusion. While timing the stock market is inherently challenging, it is not impossible. By recognizing market trends, monitoring economic indicators, and utilizing technical analysis indicators, investors can enhance their ability to make informed and strategic investment decisions. This structured approach helps mitigate the emotional biases that often lead to poor market timing and enables investors to navigate the complexities of the stock market with greater confidence. Investing is a continuous learning process, and no strategy guarantees success. However, by integrating these methods into your investment toolkit, you stand a better chance of optimizing your market timing and achieving your financial goals.
Happy trading!